not get a list of the qualifying and non-qualifying examples? Keep your hands up. I'm coming.
Okay, I think we're ready to get started. And welcome back. Did anybody else get stuck with the salad? No? Delicious? It was. It was great. I loved it, yes. Well, now we're here to the session that maybe some of you have been waiting for. We have great thanks to our KDOR colleagues here, and they're going to help us out, help us understand what happens when it leaves our hands. So first, I'd like to pass off the mic and have them introduce themselves.
Hi, I'm Charla Wagner. I'm with the Kansas Department of Revenue, and I am the team leader for the corporate income tax audit section. And one of our responsibilities that we do is also we review all the historic credits that come to us from the Historic Society. I have a couple people that review. Yes, I can. Sorry. I have a couple people that review the credits, so we are the people that take over the packet that the Historic Society sends to us, which includes your Part 1 if it is applicable, but it's also your Part 2 and Part 3. And then we are the people that want to have those KDOR Schedule 1s and 2s completed, because we're going to look at all that information along with the photos that we take down from the website also, and any other documentation that you've sent, so we can verify the amount of credit that you would like. And so we're going to be looking at those expenditures that you've spent money on your project and see whether or not that we agree that they're eligible or non-eligible. And then once we either agree or disagree, we will send a letter back to the Historic Society with the amount of credit that we would recommend for your project. During our review time, though, we will often contact you if we have any questions about some of the items that you're claiming on your credit. We either talk to you on the phone or we will send you some emails in order so that we can completely understand what we're looking at to make sure that we agree that you should be allowed this credit. And then once we're done, as I said, we send it back to the Historic Society and they send you out your credit certificate.
Hello, my name is Scott Reed. I'm an attorney with the Kansas Department of Revenue, and I am the attorney that handles historic tax credit appeals. So after the audit stage where it's been reviewed and some items may have been denied, when the item is appealed up to the informal appeal stage with the Department of Revenue, I'm the attorney that handles that. As well, if things are unresolved at the informal appeal stage, I would ultimately be the attorney who would be representing the department at the Board of Tax Appeals stage or any further.
Okay, in case you haven't already seen it, at your table are some note cards, and we're collecting questions for them, and that's mainly so our crack team can edit out the bad words or maybe eliminate duplicates. But we weren't going to start, although I think Charla covered it, most of it already, with some basic questions. And if you can maybe enlighten us some more on just what happens to the historic tax credit application when it's sent over to you, or is there any more to add to that, or you want me to go to the next question?
No,
okay.
I guess one of the things that Katrina and Kristen have both emphasized earlier this morning is that communication is such an important part of this whole process. As the Department of Revenue, we are not involved with any of the actual work that's being done when you've been communicating with the Historic Society on what exactly your rehabilitation plan is and whether or not you needed amendments and what exactly was the work that you were doing on your project. We come in at the end of the process when all the work has already been completed, but yet we're still trying to make a determination of how much credit that you are eligible for. So good communication of writing down the steps in your rehabilitation plan is very important. making sure that all your amendments have also been included when you close out your project in your Part 3, and making sure that you have good photos to help us understand exactly what you were doing is very important, because we're also trying to expedite this process as much as we can, because we know you've already done the work and you're just waiting to get your credit certificate so you can move on.
So is there anything specifically they could do to make it go more smoothly?
Well, Katrina mentioned earlier that some of the things that just making sure that everything is complete. And what I mean by that is, you've already done your rehabilitation plan. What helps us review the eligible expenditures is to make sure that you have invoices attached so we can actually look at those. In the contracts that you also might have with your project, include a copy of those, developer contracts or partnership contracts along with information. If you don't send those in, just make sure that you have them organized, because we may be contacting you in order to request that information so we can review it.
Okay, I think we're going to hear from Scott next. So what is the process for filing and going through the appeal of issued credits?
Well, I get to see part of the process, so I can't exactly speak to the filing of the appeal portion because I don't usually see that. To the best of my knowledge, the way that this works is that after the audit division or the Historic Society has issued a partial denial or denial of a credit, that one can appeal the credit up to an informal appeals process. The hearing officer that works on these typically frames it as stating that the informal appeals process is as it pretends to be. It is a conversation where we're going to have some back and forth, where we're going to be asking for some information, and we're going to be attempting to make determinations on items that have been denied. As Charlotte said, that a primary issue we have with some of these credits and some items that get denied is that there are incomplete portions within the materials that are submitted. There's either items that have been omitted from a plan or items that cannot be tied back to a specific invoice. And so the department doesn't have a full accounting to make certain that something that is being asked for credit has actually been work that has been done or is something that is indeed creditable. In the informal appeals process, once it has been appealed and once it is docketed, then we start off with an informal hearing, which is usually conducted by phone, although taxpayers may come in person if they feel they'd like to. And that is usually a clarification about what items are actually being appealed. Some taxpayers will submit an itemized list of the items that they disagree with from the denial letter that they are specifically appealing. There are some items that perhaps have already been agreed upon. And then from there, we're attempting to determine whether there is more information that needs to be provided to the department in order for something to be given credit, whether something has been asked for credit that it falls outside the scope of the things that can be credited, or if there are any gray areas with remaining items, whether or not the department and the taxpayer can come to a negotiated solution. I would say that in my 3 years of doing these tax appeals, around 70% or greater have come to some sort of negotiated solution, especially on gray area items. And that we come to effectively a non-principled settlement that determines that the taxpayer is going to receive some credit, but will perhaps be giving up some things before we'll move forward. That is, if we come to an agreement, as always, that the informal process is as it pretends to be. It is merely an informal process. If a taxpayer wishes to go on up to a more formalized process, the Board of Tax Appeals is the body that handles those after they've been dealt with at the informal appeals process.
So now we're at number 4 of our most common questions, and maybe it's my favorite question. I want to know too. How is the qualified, non-qualified list created, and how is it used in the audit and appeal process?
Well, that list that he's referring to is the list that was handed out, and the Department of Revenue really didn't get involved with the review of these credits until about 2006. And so the state historic credits, which is the ones that we're primarily talking about right now, I think Patrick mentioned that they started around 2001.
First ones would have been 2002, the first actually came.
And so KDOR didn't really get involved with this process until later on around 2006, I believe is when my group joined. And it was at that time that we didn't really have a lot of guidance. And so we found some lists that we base a lot of our things based on what the IRS also allows on some of the federal credits. And so this list has been developed over the years of what is eligible and ineligible items from different things that have been appealed, maybe through the credit review. And as we're just trying to share more information with people trying to take the credit, that we want to let you know that exterior building surfaces are generally going to be allowed and eligible expenses, but anything that you put in your garden is not.
In addition, I worked with Charlotte and some other personnel on developing the current form of this list, although the original list predates my time with the department. Some items on this list also come from guidelines that have been published by the National Park Service in showing what are eligible and non-eligible credits. As well, there are 3 IRS regulations that I draw from frequently when discussing what constitutes a building and its structural components. And these are, forgive me if I get my citation wrong, but I believe they are 26 USC 1-48, 1-48.1, 1-48.11, and 1-48.12. And I believe it's in 148.12 that actually has the term of art definition of what is a building and what are its structural components. And then even among the structural components are an enumerated list of items that are considered the structural components of a building. And so those are some primary things that the department is looking at when making a determination about whether or not something is a portion of a building or whether it's considered separate and it's tangible personal property.
And to be fair, Charlotte, we haven't always agreed on this, right? KSHS, right. So but we worked through it somehow, yes. So the last of our softball questions are, how do you evaluate and determine the eligibility of soft costs, specifically developer fees, engineering studies, and architectural fees?
Well, soft costs, as he mentioned, the big one is typically the developer fees. If you're rehabilitating your house, you probably have not obtained the services of a developer. If you're just going to do some minor repair, well, more than minor repairs on your house. But if you're rehabbing maybe a commercial building, you might have contracted with a developer in order to oversee that project. And so developer fees, as they relate to the project and to your historic building, is an allowable cost, but as the IRS says, at a reasonable developer fees. We had a situation this morning, I believe. There's a community looking at rehabbing their library and wanting to add on an addition. Well, the addition would not be an eligible expense and related to the historic credit, but the changes that you make on the historical part of the building may be allowed. Should in that situation you hired a developer to oversee that project, we would take a look to say that the time that the developer spent in overseeing the work done on the historical part would probably be eligible for the credit, but maybe not for the addition that you're adding on to. And so we're just trying to be somewhat reasonable in the amount of expenditures that are relating to the historical part of the building that would be allowed. And we're kind of taking a similar approach then also for like the architect fees or engineering studies, if you have a project that has like a major addition on it. We would like you to actually make a calculation of what you think it should be. We may or not agree with that, but whatever part that you might think should be ineligible, you could put that down. Oh, the question was, should the applicant make a reasonable guess on what they think it should be in regards to how much of the developer should be eligible versus non-eligible? And we would say, yes, we would appreciate, because you are more firsthand on what you're doing in your project, and we're just looking at it from a review perspective.
Okay, and now we are to the first of our audience submitted questions. Yay. So this one is a good one. What is the most common item you see on applications that is often ineligible?
Well, what we often see that we find to be ineligible is when we're looking through your list of invoices, we run across invoices that says something about, we had to shore up the foundation. And when we look through the rehabilitation plan, there is no mention of any type of foundation work. And so if the step of the process of reshoring up your foundation is not part of your rehabilitation plan or not part of your Part 2, then we can't allow you that expense. It has to be part of the rehabilitation plan for us to give you, consider that as eligible expenses.
Right, and I believe we stressed in all of the sessions this morning the importance of having everything in your Part 2. Well, I jumped ahead because we have one that's somewhat similar, and that is, but since you mentioned receipts, it says, why don't you ask for invoices and receipts up front? It is hard to go back later when you're not as organized. Or even when you're organized.
Well, I think we saw some slides earlier this morning, too, that also mentioned on there that you need to keep your invoices and stuff kind of organized because you're going to need to list everything on your Schedule 2. So if you would like to go ahead and submit those when you send in the rest of your paperwork at your Part 3 along with your Schedule 1 and Schedule 2, by all means send in your invoices. That does help expedite the process because that's one of the first things that we're going to ask for from the Department of Revenue is, now that we've got your list of all your expenditures, now we need to verify those against your invoices or your AIA documents or whatever, anything else that you have to verify these.
Okay, the next one is is the interest on a construction loan eligible for tax credits?
Yes. The interest that you pay during the construction period is an eligible cost that is part of your project.
Sorry, and I'd like to add to that. Again, I came inadequately prepared without my sheaf of citations here. And under one of those regulations that I cited to earlier, there is another small enumerated list of capitalized costs, and in that list, it also lists items that are that are intangible costs that may be included within or considered qualified costs, and construction loan interest is among those costs. Off the top of my head, I couldn't tell you what the rest of them are, but perhaps I'll see if I can find that citation for providing later.
Okay, and we have another one following up on developer fees, and it says need consistency on projects on developer fee compared to the next one does not. And then how is a reasonable developer fee determined? And this is not in regards to additions, just straight up.
I guess in regards to consistency and also what is a reasonable developer cost, one of the methods that we have used that we think is reasonable is maybe sometimes it's a square footage determination. And that would probably bring us back more to if there was an addition or if there's other non-contributing parts of buildings on your project. We've also used to come up with just a percentage of cost. If we find other things that are ineligible, we might come up with a ratio of ineligible to eligible cost and apply that to your soft costs, such as your developer fees. I don't know if that's enough.
So the next question is, I have two elements of my project that are not specifically included or excluded on the list of expenditures. There's quite a few of those. And this one, I think it's a heating loop or radiant heating installed under approved carpeting, and then hearing. I see. Okay, a hearing loop. And then the other one is a bell restoration for the actual bell itself, which is part of the original architecture.
I don't know what a hearing loop is.
It's hardwired
Is it a heating loop?
No, hearing. It's audio.
Oh.
It enables people with T-coil hearing aids to tie directly into the sound system so they can hear it like it's coming out of the speaker directly into their
Breaking new ground.
It's new technology.
Well, we haven't come across one of those yet. We are getting ready to, but what we've done with other types of wiring, such as maybe security systems or other types of system, usually the wiring that is enclosed within your walls and stuff is usually eligible, but the tangible personal property elements such as maybe the speakers and other things are usually not eligible. But once again, these are usually all facts dependent on each particular situation, and so we would need to see some additional information and also pictures, and we would probably go online and see what does the company also say about this type of product.
So you mentioned tangible personal property. Is that one of the factors whether the owner can easily remove it and take it with them?
Yes, that's exactly it. As we've talked about, to be eligible for the building credit, it has to be a structural or component part of the building, and that's real and tangible real property versus tangible personal property, which is tables and chairs and other things, cameras that you could remove and take with you, and is depreciated usually less than 12 and a half years and that type of thing.
Right. I think before we got such an exhaustive list, we used to explain it as you could pick up the building and shake it. If it didn't fall out, it was eligible. That's not always the case. No. Not always. And okay, so what about this bell? We have a bell and a historic bell tower.
You have a bell and a historic bell tower. Well, we've seen bells in lots of different places, and we've run across bells before. Once again, it's going to be kind of factually dependent. If the bell is in the bell tower, I would often have to look at pictures, confer with my attorney. He's right here. But if some bells we see are set on the ground in front of the building, and as such would not qualify. If they're a bell in the tower, I would imagine we would have to look at it. I would imagine most of the time I think it would qualify. If it is a structural component part of the building.
So similarly, we had an issue in the past with marquees, and that changed to where initially they weren't eligible, but now they are.
Well, very similar with marquees and awnings and other types of overhangs that you have on your building. If you can take it off and remove it and repair it and put it back, it's probably not going to be eligible for the credit. If you have a theater marquee, which is those elaborate brick things that come out from your building with the lights on it and not just a sign, it is a structural component part of the building, most likely those repairs to that would be eligible.
Okay. So have the rules changed in regard to creating a for-profit entity to combine with a non-profit entity to qualify for federal tax credits?
Unfortunately, I don't do federal tax credits, so I would not be able to answer this question.
And I guess for the record, we're not aware of any rule changes, but we can't really comment on that either because it's outside of our purview. So that was easy. Let's see. So are tools and equipment needed to complete work being done by homeowner as an eligible expense if receipts are included?
It depends on what kind of tools and equipment that you're getting. If you're just buying a hammer and the hammer could also be used for other projects other than the historic credit, then no, your hammer is not going to be allowed. That would be considered tools. Scaffold rentals might. If you use just for this particular project, yes.
So this next one is, we appreciate the updated list of QRE last fall, but it seems like there are several things that are being disallowed. That's kind of a general statement. Any comments?
Yeah, it is just a list. There are things that are getting added to the list. There are things that change from one column to the other on the list, and there's things that we actually take off the list. So, and like many other information requests that you get from the Department of Revenue, it's constantly changing.
And I'd like to highlight in here as well is that I believe we threw it in kind of sizable letters on the front page that this is considered to be a this list is not absolute. Every factual situation will be reviewed on its own merit. This is an attempt to give a guide just so we can have some guidance for taxpayers to know if they're going to do work, what things might be eligible. As well, I believe that there'd be no problem with further inquiry, as we're doing here, with finding out if some work that would be done would be something that we considered qualified expenditures or no, and that I guess without having any specificity on the question here about what possibly is being considered to have changed, I can't speak to that issue. But again, that what the department is looking at, or at least what I'm looking at in some of these appeals and reviews on here, are whether something is the building and its structural components, and that when you're getting any further afield from building structural components or anything that's not enumerated under the statute, I don't know that the department is going to have as much of a basis for giving a credit, which is where we are on these projects.
Okay. Are contracts required for all services that are purchased, and when is proof of payment sufficient?
No, contracts are not required for everything that you purchase. If you go down to Home Depot and buy whatever supplies that you need for your job, and if you submit those as part of your Schedule 2, and it meets the requirements that you wrote down on your rehabilitation plan, that should be adequate. If we have additional questions regarding your receipts, that we will probably contact you to get more information. But you do not have to have a contract for everything that you do.
Okay, so this one is interesting. Kitchen and bathroom cabinets and countertops are at the discretion of the Secretary of Revenue. What are the determining factors?
Actually, this one's pretty basic, and it's not quite at the discretion of the Secretary of Revenue. Rather, the reason that these are considered in the eligible qualified expenditures category is by the grace of the Secretary of Revenue. I believe this started under Secretary Nick Jordan, although perhaps predates him, and the determination was at least under guidelines and under what's a building and structural components, cabinetry is tangible personal property. They can be removed from the walls. They can be taken out. Generally, would be considered not qualified expenditures. But Secretary Jordan, and his experience in doing items with building trades as well as renovations like these, determined that kitchen cabinetry and bathroom cabinetry, or at least kitchens and bathrooms, because of their nature and function, would require cabinetry like this. A kitchen needs a counter, a bathroom needs a cabinet for its sink, among other things. So it is a grace item that says that the cabinetry and countertops that are put in bathrooms and kitchen are considered qualified rehabilitation expenditures, though the guidance otherwise would say that they are not. So it's not the determination of the Secretary where he's looking at each item and deciding yay or nay whether it is eligible, but rather the cabinetries that are in kitchens and bathrooms are what are considered eligible. On the same token, Secretary Williams made a determination, it's not included on this list because we've just not updated it, but that on this list, I believe it lists that carpet tiles and ceiling tiles are considered tangible personal property and are not eligible. But Secretary Williams made it a grace item to say that they were. Now we've got a change of government, though, so we've got a new secretary, so I'm not certain what items will continue to be grace and what won't. I hate to say that that's an issue we were talking about was consistency. But because, as we're talking about tangible personal property, these ceiling tiles can be taken out and walk out the door. As well, these carpet tiles can generally be pulled up. And so that's why they were considered tangible personal property rather than real property.
I assure you, Scott, no one's taken these tiles or the carpet. It's pretty used up. But I know what you're saying, So this also brings up a good point. I mean, we do want to know what to expect, but what we often caution on the front end of projects is, again, hey, this is a preservation project, and the project is really to help defray these specialized costs, as was mentioned in some of the earlier sessions on getting a craftsman to repair your windows, etc. And, really you probably shouldn't get down to trying to factor in the cost of cabinets on the front end planning, because again, this is a level that's getting in the gray area, and the known knowns should be enough for you to plan your project. And the next question is a little bit similar, and it's, if submittal is less than $5,000 but approved expenses is greater than $5,000, is project denied? No, that was just opposite. Sorry, I read it wrong. So if you had submitted it in and you thought it was going to be more than $5,000, but your actual expenses are less. So we were going to process that. Charlotte, what are y'all going to do?
Unfortunately, if your actual expenditures that you submitted to us are less than $5,000, we're not going to improve anything.
So this is where I was getting back to my front end. Make sure, add some extra painting in or something. Those guys are making a killing, so surely you can get over $5,000 on your project.
I might add on a couple times when that's happened, when we have had Part 3s come in and they're under $5,000, our office generally recommends that we hold it open until you have additional work in the future.
Good point. Yes, we've seen that, right.
So that doesn't happen. When they don't actually see that, we'll give you advice to try to avoid that.
Right. The second part of that question is, what about furniture that is integral to the structure or the architecture? And the example is Frank Lloyd Wright chairs, which would look good in my office, by the way, Charlotte.
They would look really nice. Unfortunately, they would be very easily moved. And because of that, they would not qualify for the building credit, but they would be lovely additions.
I'm all for it, but yes. So, we're back to developer fees. When is developer fee not QRE? And it says developing a project developer fee is often an expense, but guidance says reasonable developer. So I guess we're defining reasonable again?
I guess once again, reasonable is kind of one of those things where what's I believe is reasonable may not be the same thing that you think is reasonable. Developer fees are generally an eligible expense, but developer fees are usually one of those items that sometimes are taken advantage of, and we may see exorbitant amounts of developer fees. So when that happens, we might be taking a closer look at those and asking for your developer contracts and verifying some of that. We also might be comparing those to what other developer fees are that we've seen for similar projects to see, is it in the ballpark of those? And so I guess that's how we go about kind of defining what reasonable is. Do you have anything to add on that?
While it's true that Kansas does not have a specific line item that in statute or under regulation that states what constitutes reasonable, that's going to be an issue of fact that would be argued. That would be argued if it were to go up to that level of the appeal stage. As Charlotte had mentioned, that when we're looking at the reasonability of developer fees, one of the ways of determining reasonability is looking at the amount of the developer fee charged versus the actual amount, the actual hard costs or all of the remaining costs that went into the building. Because when if you have a building that, as an example, has, let's say it had a $100,000 worth of hard costs, and that's all the labor and all of the materials that went into the building. But if on the same hand you were asking for $60,000 worth of developer fees, you're talking about a ratio of 60 to 100 or 6 to 10 or 3 to 5. Sorry, I told there'd be no math. When you're getting up into well beyond, well north of 30-40%, you're entering into the territory of unreasonability. Now, we haven't had a test case in the state of Kansas in determining what is reasonable, and as I said, we don't have anything in statute, but that is something that would be argued and would be a real question of equity about determining whether something is reasonable. I've worked on a few appeals where we have negotiated with developers as to a reasonable developer fee, where we're looking at totality of the circumstances, the developer fee versus hard costs, and taking guidance from a few other states. But again, reasonable is still a fairly nebulous term, so we don't have a perfect answer for you.
Great. Well, we have reached the end of the note card submitted questions, but I know there's some more out there because, well, some people told me those before the session. So I guess we go to open mic time. Do we have any questions from the audience? Yes, sir.
I think you might have been referring to the conversation that we had, whether the taxpayer was providing his own service and doing the labor himself, or if he was going to hire his nephew to come over and do it. Okay, and in general, if you do the work yourself, you're not paying anyone to do that, and you're not expending anything, so you would not receive a credit on your own labor. If you hire someone else to do the work, then yes, generally an explanation in your rehabilitation that this is what I plan to do, and supporting documentation of canceled checks and other things may be written on there, may suffice. Granted, we do get into a lot of intercompany transactions when we have one LLC who owns the building and the same people of that LLC then do all the construction services. And so we have to be able to understand what all is happening. So as I said, communication is a big part of this. So in some of those situations, we may need a contract when we have a lot of different similar LLCs all doing different parts of the project. We might need to understand the contract of who's doing what and who are all the parties involved. But in general, usually if it's a simple project, I hired my neighbor to paint my house. This is how many hours he worked. Here's his paycheck. Often that's sufficient. I think you had a question over here this morning is you're already an employee of the organization, and typically those costs are not allowed to be eligible because you're already an employee of the taxpayer, and your costs may not be capitalized as part of this project because you're already being employed expense. But as I said, every situation is slightly different, and that's sometimes what we have to get additional information on. Unfortunately, if the ramp is outside, usually most of those costs are not eligible because it is outside the historic building.
But it is something that we deal with on the rehabs, and we will review it to make sure it's, while meeting ADA is the least impact on the historic storefront or building. Right, it's still not eligible if it's within the district because the tax credit's tied to the building itself.
I have not seen one of those in any of the reviews I've done thus far, and I'm not exactly certain how that would be handled. Because really, when we're talking about what's eligible, we're talking about this is for a 25 or 30% credit for the expenditures, and when you've got something that's an exchange of something that's intangible that might not necessarily have a dollar of value attached to it, I don't know how we're supposed to quantify that. Now, if this were to be something along the lines where the developer pays you $10,000 and then you turn around and give the developer $10,000 to buy $10,000 worth of share in the company, then that's something that's possibly quantified. And at least from there, we can say that's what the valuation of was, that's what the services, how much we're paid for the services. But if you're just talking about that you're given a certain stake of the company at the time, you have the multiple problems of making a determination of that value, and then upon what basis does the state give a credit for that amount of property transfer.
Way in the back.
Yeah, I would agree. There's a lot of different types of flooring that are out there, and you're asking about what is considered less permanent flooring. The IRS has some different cost segregation guides that we often take a lot of information from, and on that one, the VCT tile is actually listed specifically in some of the IRS guides as being a less permanent type of flooring. And so we've also kind of adapted that too, because it would not be allowed on federal projects, so we're not allowing it on state projects. However, as Scott just mentioned, now carpet tiles are being considered as eligible, whereas usually before the rule of thumb was if your carpet was tacked down, it was ineligible, but if the carpet was glued, it was allowable. So, I mean, flooring as time has passed, we've got all different types of flooring that we're now using, which are much easier to install. And so trying to get a consistent approach on all the flooring is really led us to remain on more kind of a fact dependent or a situation dependent. If you put down hardwood floors, most likely those are going to be allowed. Anything other than, as you move further to less permanent, you're getting more and more to the gray area. And sometimes we've seen in projects where you have to preserve the floor that's underneath, and so you've put some less permanent flooring on top because you have to protect the historical element of those hardwood floors. And so almost anything you apply on those is not going to be eligible because it is supposed to be less permanent because you're just protecting the floors.
I would say in addition, and I believe what you're referring to there is what's called a floating floor. So floating floors, I believe, are covered under guidelines, under the regs, as something that's considered non-permanent. As well, sort of a very key phrase in the regulation that speaks to the building and its structural components. The key phrase is that things that are permanently attached to the building, and so that's sort of where that determination comes in. There's a little bit of guidance on that when it comes to tacked carpet versus glued carpet, and that it's not straight up in the regulation. It is in sort of secondary guidance that says that gluing is more permanent than tacking, so the IRS regards tacking as being non-permanent and therefore ineligible. But even there, we don't have a complete set of guidance, so we do have, as Charlotte said, we have to go a little more fact-based on these things. And guidance as far as vinyl flooring goes is that the guidance at present says that vinyl is considered non-permanent, and so therefore not permanently attached, and then therefore ineligible.
We received another question on the note card. So it says a porch is outside the building and is an eligible expense. Can you talk about how that differs from work on an ADA ramp that is permanent? And my comment to that is, well, the porch is, as long as it's a historic feature and was there, even if having to be rebuilt, it is a historic component of the building.
And we followed your guidance in regards to that. Once you leave the perimeter of the building, all your expenditures become a little bit more suspect. I mean, because the credit is actually for the historic building. In porches, we've seen both ways, decks. But if the porch is part of the historic features, we have allowed that even though it's outside the building. But if you're adding on a new deck or expanding on a deck, or if you, in this situation, if you had a porch and you expanded the porch, the expansion would not qualify, but we would allow you eligible expenditures for maintaining and repairing the historic size of the porch.
Any more questions from the field? Bill?
Another variation on working with in-house employees and so forth, particularly small municipalities where they might use their own employees on a specific remodel project or something like that. For instance, the case I'm talking about is converting a small city hall to a library, and they're probably going to use their own city employees to convert that. Any of their
Typically, no. That once again, they're already your employees. You're just assigning them different duties. Well, then you are required to capitalize those expenditures, their employee labor and stuff, as part of the cost of the project, and depreciate that. And that's one of the qualifications of the cost, is they have to be capitalized. Once again, those are all kind of dependent. Usually, maybe the interior millwork may be more of a temporary nature as opposed to the exterior millwork. Once again, it all depends on if it's stone millwork outside, or I don't know. Pictures provide a lot of information in regards to some of these items. Usually door and window casings are considered structural components, and they're eligible. Right.
So if I have a subcontractor who's working on the building and he's doing $50,000 worth of work, and $1,200 of it is going to be for permanently installed wiring, which would be an approved expense behind the walls and so forth, and then the floor cavities, do I need a separate invoice? Or, well, then that's when you would need the contract then to show how much of, I mean, somehow it's got to be broken out so that you see that my $50,000 check to him didn't, $1,250 of it was.
Right, if he sends you two different invoices for the same thing, or separate invoices or description, if that provides the additional information that we need to make that division, then yes. That's your question.
Well, that's an excellent question. Charla handed, the question was, how do these tax credits fit in the state budget? And it's our program. We know how many credits get issued yearly, but it actually comes out of, Charla handed the mic to me, but it actually comes out of KDOR's budget. And they use historical data on credits claimed, which is different from credits issued. And so it's actually a part of KDOR's.
Yeah, these are non-refundable income tax credits. So these credits are used against your income tax return, whether they be your individual or your corporate return, or insurance or banking or whatever. But those are the only ones that are allowed the credit. So we probably make a report every year to the legislature of how many credits have actually been claimed against the tax returns that we've received. And as this is a 10-year credit for the owner taxpayer, it takes 10 years, could take up to 10 years for them to take the credit, or they could use it all in the first year. We report that information to the legislature when requested to do so every year or every so many years. But we do keep that information. That's why it's so important that the Historic Society and KDOR worked cooperatively with this program, because we're both needing the information, because each one of your credits has to be matched up against a tax return at some point, whether you're taking the credit or you've sold the credit or transferred the credit. So we have accurate information to match it up with that return. So when you submit your income tax return, we can match it up and process it through. If it doesn't match accurately, that goes to someone's work list and requires us to contact you and say, hey, there's a problem with your return.
Bill first.
Okay, I have one kind of general question. There's a bill before the legislature now about justification of the several tax credit programs, but specifically the historic tax credit program. Will the society be responsible, if that should pass, will the society or KDOR be responsible for mounting a defense of that?
Bill has mentioned there's a current House bill, I think it was also introduced last year, that requires a reporting of all the various tax credits out there. And currently as written, and this has been discussed and brought up by some preservation advocates, it's that the Secretary of KDOR will make that report. But as Charlotte said, always in the past they've worked with us because we calculate the economic impact information, as Katrina showed earlier this morning. And so, but there has been talk of even amending that bill to make sure that our name is in there because it is a program that we both administer. But again, yes, there is a bill and it is a reporting, in general reporting requirement on all the credits, tax credits. And as written now, it's the Secretary would do that report. And we had another question.
No, unfortunately, if you, you're asking if you have a tax credit, you do have, as the original owner taxpayer, you have 10 years in which to use that credit. If you decide you're not going to use it in year 8 or 9, and so you decide to sell it, then whoever you sell it to only has 1 or 2 years to use it themselves. They have to use it, they have 5 years to take the credit, but it has to be used by the end of the 10th year of the when it was placed in service.
Another question about what if a non-qualified expense is incurred because of a qualified expense? Say I have a chiller unit that's a qualified expense on a certain property, but it's behind a fence, a huge fence that's going to need to come down and be replaced to get to that, to replace the unit. Would the fencing then become eligible?
No, if the fencing is outside, it's not going to be eligible. We're going to replace your cooling, though. Your cooling unit, even though it's out, that's about the only thing that we allow outside is just your HVAC systems.
In that enumerated list of what are structural components, HVAC is considered structural. So, and that we don't make a determination about if it's inside or outside of the building. So as Charlotte said, that's one of the few items that can be external to the building that will still be considered qualified. But having non-qualified expenditures that are necessary to get to qualified expenditures, that there's not a transformative effect. Having to do extra work does not transform something that's not qualified into being qualified.
Along that same lines, if I'm going to replace this carpet in this room, which would be a qualified expense as long as it's not carpet tile, it's glued down, right? But I needed to remove all the stuff in this room to do it, and store it off-site and then bring it back in. Is the labor involved to do all that it's part of replacing the carpet?
Yeah, it's part of replacing the carpet, but it also gets broken up into different parts. Moving tangible personal property such as the tables and chairs and putting them in a storage unit is not a structural or component part of the building. Church pews are kind of fun. I like those. Some are attached, but then we get into specifics on how they're attached and would they damage the building if they're removed. So church pews, like theater seating, are a factual situation of each project.
So we'll just deal with that in the project?
Let's do that during the project.
Two questions here. Let's go to the middle. We haven't heard from him. Then we'll go back.
I didn't quite hear you. What type of HVAC? Okay. On that one, I would have to do a little bit more research to see what we've done in the past. It's not normally what we usually see is just HVAC systems. Well, correct, but it does have a lot of stuff in the ground. And for that one, I would just have to say, I would need to do a little bit more research on that one. I'd be happy to talk with you later. Now, elevators, it kind of depends on what kind of elevator that you. Yeah, he's asking if an elevator is an eligible expense because you need it for handicap. It's outside the footprint of the building. Would an elevator qualify? And if it is outside the footprint of the building, then no, it will not. If it's inside, most likely your elevator would. Yes, it does make sense. You're asking whether or not a group of individuals that are electricians and plumbers get together and buy a building and then they do the work themselves. If they've invoiced back to the other business, then and they're treated as like a customer, then I think there would be a very good chance that that would be eligible. No, the credit goes to the owner of the building. So however you've structured the ownership of this building, that's who gets the credit.
I think we're down to one last question, Brenda, and you're it. What the question is asking when is the placed in service and how much time do you have afterwards to wrap up all the payment of your invoices. The placed in service date is one of the dates that's requested on your Part 3. So often from a review perspective, that's the date that the reviewers are going to look at. If you've placed down that we're done and it's in service as of June 30th, that's kind of our placed in service date. And we typically will allow you, if we still see invoices and payment of invoices coming in at least 30, maybe sometimes 60 days after that date, and we can tell that the work was done before the placed in service date, we would be allowing those eligible expenditures.
I wouldn't think so, because you're in charge of putting in that final date. And if you're not done, I guess this is more of a historic credit question.
I think it would just be a whole nother project and application at that point after place in service. Yes.
I just want to amend to that a little bit. So as the taxpayer and as the project head, you are in the driver's seat as far as what work you're doing, what work you're noting, what materials. You can make a lot of choices, and you're telling the Department of Revenue and telling the Historic Society that you have done these things, and you're asking for credit on them. As far as the placed in service date goes, though, you do get to choose when you're putting the building in service, because that's part of the things you're going to do within your project. But also keep in mind that beginning to occupy a building is evidence that the building is ready and that it is complete. Now, I don't know about doing phases or occupying portions of the building, but beginning to put people into the building is putting the building into service. And placed in service is something that comes from the federal statute. So that's something that we will be mindful of. Now, again, if we're talking about a short period of time where some people moved in on Monday and you had to do a few pieces of work on Wednesday, that is a lot closer in time than saying you're going to have people moved in and start doing things in the building on June 1st, but you're not going to claim that your place in service date was until July 31st. That's a bit longer of a window. And as far as remedial items, again, it's your project. You get to figure out what had to be done, and that if it wasn't done when you completed your project, you're falling, sort of, as Patrick alluded to, you're sort of falling outside the window of the current project.
All right. Well, thank you so much, Charla and Scott, for coming here today and fielding all these questions.
We're going to take a break until 2:30. The civic properties, and if you're a nonprofit theater, we had several people asking